trying to understand what is the best model for some of the financial centers around the world to use in the future. So whether the centralized and universal, let's call it, model should be the one that people should sought after, or perhaps everybody should just move towards a more specialized niche markets. What are your views?
Well, I think none of us are going to be beating sort of London and New York anytime soon, but I think it is important for a centre to have particular strengths, you know, and with Toronto, with Canada's financial centre, it's very much the financing and the for mining metals, energy, clean tech financing, the talent pool around that, the expertise, commodity-based economy, whatever. So I mean, that's certainly one of our clear strengths. But I think one of the other things that also helps the sector is the ability to have some breadth and some depth. And so, you know, we have the strength in pension and asset management as well. We have a talent base that is very diverse and is seen, and governments again recognize the importance of building that talent base through the educational schools, et cetera. But again, it's also a talent base that has the kind of business, cultural, linguistic ties globally, because we have, you know, like over half the people in the city of Toronto were born in other countries. Very diverse economy, or people, talent base, over 180 languages spoken within the city, et cetera. So a recognition about the need for that, as well as the macroeconomic values that are really, really important.
I think we naturally attract a breadth in terms of skills, and there'll be the different service providers that need to come in and support the industry, and then the companies that support them. So there'll naturally be a bit of that. But to really focus on and support a niche, if we want to call it that, or a specialisation or a couple within the financial services sector, which at the end of the day is so broad. To say financial services sector in itself can be misleading in terms of what you want to focus on. So if you do recognise where that niche is, and you know, for our region it's very much around asset management, because the majority of the 1.7 trillion that's in super funds in Australia is managed out of Melbourne, and I think there are so many advantages in that. So to move away from trying to be all things to all people, and actually recognise we want to do one or two things really well, means that for your talent pool, you are naturally investing in those skills that are going to assist and help you grow that part of the sector. You are going to naturally start to attract more global participants into that sector, because they can see that cluster, but that specialisation within the cluster growing. And then from a promotion point of view, it really makes it a lot easier as well. At the end of the day, the world we live now in a global world. We're all competing against each other in some way, whether it's on a resources platform or a financial services platform, where we can genuinely find those niches and invest in them, and know that as a global community we're all actually making that pie bigger and better, I guess is what we're all aiming towards, rather than trying to continually cannibalise a sector.
Should London be worried about all these financial centres specialising in some of the niches and potentially getting part of the financial sector out of the capital?
Quite the opposite, actually.
Okay.
We've just signed a memorandum of understanding with Moscow to help the development of their financial centre.
Okay.
We're working very closely with Istanbul on theirs, and what we're trying to do is help the world's financial services centres grow, because of course, as was being said earlier, financial services is the bridge. Yep. Actually, we are the bridge between an aspiration to grow and growth actually occurring. And so we see it as part of our role to help the development of the industry around the world.
And what London's been doing, actually, I mean, again, just speaking for the Toronto financial sector, was very, very helpful. There was a series of studies that were done some years ago about what a financial centre needs to build and to grow, and now we've got the Global Financial Centres Index that's out there talking about where we all rank from time to time. And we also had signed a memorandum of understanding with the old IFC IFSL. And again, that cooperation, that sharing of information, that willingness to come and help us grow. And Toronto was not, I don't think anybody saw Toronto Financial Services as a global center. And then two things, I think, the success during the crisis, if I can say that, I think helped put us on the map. But secondly, the learnings that we had from the relationship with IFSL, and now, you look at the index and Toronto, and again, it's an index and they can fluctuate quite a bit, but we take some pride in being sort of in the top 10. As there for the and I know, and actually what we really, because the first index that came out, we were about 12th, I think, and the report actually sort of said something about, surprisingly, Toronto was like, who knew? So
that's right. But Toronto has actually come out as a very strong financial center, especially after the latest. And you may have seen that the bank has also put together a ranking of international financial centers, where there were a few surprises.
We're seventh in that, but we benefit. I mean, I think what's really important is that mutual benefit has helped us grow, and where we got from London, New York, and we look forward to. We've been doing some stuff with Mumbai, so we look forward to continuing that kind of partnership, a relationship.
To echo, the model seems to be very clearly that the top, say, 3 now almost financial centers, the full service financial centers, if you may, New York, London, Hong Kong, they're going to stay or at least the way we look at it is they're going to stay these full center financial services, and they're going to be fed by a host of regional, focused, niche-oriented, specialized centers. And I think the responsibility of these niche centers would be to grow the size of the pie for everybody. Our own experience since 2010, when we announced our hub strategies and the focus on asset management, reinsurance and captives. So in the same indices, we've seen Qatar creep up slowly because especially towards the developing side, where you're still building out that legal infrastructure, the regulatory infrastructure, the tax environment, you're still working in that environment. It's important to be able to also focus the regulators and the policymakers on rather niche sectors rather than the entire financial services, where it's difficult sometimes to find coherence. And that focus sometimes helps attract the world's attention, get the right people from that industry globally involved, and work with other stakeholders in the country to help build that up. So definitely I can see that, even from our side, the model that we seem to be all talking about is very similar.
Stephen.
Well, those rankings are interesting because, well, there are some beauty contests, and obviously we're very happy or proud when we go up a few positions, or when we are lowered a few ranks. But so again, you develop expertise, and if you don't have it, you build partnerships with centers or with banks or with specialized firms. If we are financing mine, we will call you, Janet, because we have absolutely no expertise in Geneva, I believe, except we know how to finance the transaction of the silver, of the gold, of the grains and the sugar to some other destinations. But that's where we can be complementary. So I see it as niche, but complementary in the action.
So it's one part competition, another part is cooperation. Then
hopefully it's constructive competition.
Constructive competition.
Well, it's called, I think it's called co-opetition or something. There's a new word, and there's a new word that somebody coined to cover it.
And there are new products as well. I mean, as the industry grows, and certainly with the carbon tax being introduced into Australia, as we see the growth of products, regulation, trading platforms, etc. We need those combined skills to come together, and that's certainly something we're very focused on at the moment, is making sure that we've got the right capability and capacity again to support what's going to be and is already as an emerging new subsector within financial services. So as we see new products, and I can't even imagine what's going to come out in terms of new products after this latest round of sovereign debt issues. We've got to come up with something.
Do you think there is space for innovation? Although
if you take Islamic finance, the UK is the Western world's leader in Islamic finance already, and yet that's a sector that's really in the foothills of its development. So I think there are a whole plethora of new and interesting areas that are going to be emerging over the next 5 to 10 years, which we can already start to see the development of today, but it's how quickly they leap ahead. And that should be really encouraging for our politicians who are worrying about, well, where is the growth going to come from?
And industry is usually very good, you know, necessity breeds innovation or invention, as they say. So we need to allow industry enough room to actually support that innovation.
This is what
grow,
some are worrying at the moment, that
yeah.
innovation might be just stopped for fear of.
And that is a valid concern. But it also, I mean, if the financial sector is allowed to let that creativity and that innovation go. For example, in Canada now, I mean, we have, you know, a very strong pension system nationally, and some very significant pension funds who are out sort of, you know, becoming growing global players. But that whole concern around retirement income options for citizens, like a lot of countries, is, you know, the population's getting a little older, and we've actually are in the process of developing a new pension product, pooled retirement pension plans, it's called, so that smaller employers have an opportunity to provide pension plans of some kind for their employees, because we all know the pressure that defined benefit plans have been experiencing. So that allowing that innovation to go, allowing that cooperation and knowledge, that relationship between your policymakers, regulators, and the industry. You know, in Canada, like, we're creating a whole new pension product, which, you know, will benefit consumers, will certainly benefit employers and small employers in terms of attracting, and certainly is going to strengthen, you know, our already strong asset management strength, you know, more assets under management, more jobs, and more benefit for our consumers. So it can work to the benefit of everybody once in a while. And I think, as Chris said, making sure that those success stories are told so that we can continue to allow that to happen.
New products and creativity, certainly, but we must make sure that they are understandable. And that was also an issue 2 or 3 years ago, where lots of customers were disappointed about their banking advisors, that they had purchased products that they really didn't understand, and to some extent did the banker. So there was lots of rancor, and it's being addressed now, because the industry realizes it must be more, I wouldn't say transparent, it's a matter of being pedagogic, to explain things in matter-of-fact way, you know.
Can I just ask a little bit of a controversial question, perhaps? You talked about making sure that the products that are created and sold are understood, but then we seem to have run, or potentially are running, a similar situation with the ETF products, which are now being created in a highly complex way, that they are synthetics products, and of course they are linked to what has happened to UBS, to the rock trade. So
UBS
are we
in London?
UBS, just to be okay. Sorry to just look at you when I mentioned it. Yes, of course. So are we sure that we are safe from the risk of running into these issues again?
Well, all I'd say is complexity is not necessarily a bad thing. I don't really understand how the combustion engine works in my car, but I know that it works. So I have confidence that the combustion engine actually has been tested to the point of destruction, if I can put it that way, and is actually safe for me to drive. So the simplicity of the product, I can get into a car and drive it, shouldn't be at the expense of understanding that there's a very technical piece of engineering in the car. So we have lots of discussions about all we need is simplicity of products, and I think that can be a misleading description. What we need is transparency, and what we need is then accountability of organisations, of individuals, and very good regulation. But actually, it does come down to the customer understanding what they're buying, and the social utility of that product. But that's not.
I haven't seen a product recall in the financial services market. No. So it's also to do with the regulation that happens at each piece of that complexity. Because if you think about the process of putting a car together and the regulation that goes with it. So I take the point, definitely. It's not necessarily an evil thing, and I'm sure the derivatives industry would agree with you absolutely, who feel that they've really borne the brunt of the last one. But nevertheless, there's got to be some simplicity at each point in how it actually all comes comes together.
Well, I think that underlines two important things that also need to happen in any jurisdiction. One, it's your financial literacy of your population, but I think the other factor is your risk management. Partly it's regulation, but unless you have a talent base within your sector that understands risk management, pays attention to risk management, and is enabled to act on those judgments, I think is really, really crucial, because at the end of the day, it's those kind of individual judgments that are going to make or break your financial services system.
And corporate culture, because even within
Very
having
much
worked in
corporate
a
culture.
big bank,
Yes.
you know, you might have somebody that on the risk side that says, hang on a moment, but then if it's a vicious cycle, if ultimately your main aim is to get best returns for shareholders, and they are often short-term aims as well, particularly the way the reporting and analyst system works, with all due respect, within our sector, it drives behaviours that are counter often to what the risk management process is saying. The consumer education part, though, is really important. And some recent survey work done in terms from a retail banking point of view on what's the number one motivating factor for people walking into a bank. So we're talking retail customers at the most basic level. What do we think the number one motivating factor is? Now, I couldn't guess, and everybody else around the table couldn't guess, and it was fear. For the retail customer walking in, and we've all touched on a number of reasons why. Being ignorant or not understanding, or being fearful of a whole system that for which they don't have the perceived requisite knowledge to really understand what they're doing, not having enough money, not having the same money that they thought they had in the account because there's been some catastrophe and their funds have dwindled somewhat, whatever it may be. It's fear. And it's a really a sad situation we've got ourselves to, and a real reflection, I think, of what's happening in the market, regulation, politics, etc. That for a person walking into a bank, their number one motivating factor is actually fear. And that's the factor they're using to make decisions.